TSX outpacing the US market once again this year. That's after outperformance in 2025. Can this run continue? We're joined by Mike Vinokur, portfolio manager and senior wealth advisor at Propellus Wealth Partners at IA Private Wealth. Mike, great to see you. Thanks for joining us.
Great to see you. Happy New Year.
Happy New Year. So, I mean, obviously any index, it's a little misleading because some groups are strong, others can be weak, but generally the Canadian market doing well again.
Absolutely. I mean, you've got, this sort of reminds us a little bit of the 2000 period. If you recall, we had this 2000 to 2006 period where commodities just took off.
As China went gangbusters.
Yes, yeah. And also you know, it was the time I remember distinctly when oil hit $10 and Warren Buffett was investing in energy and commodities and everybody called him a dinosaur because it was all about tech and not about the things that make the world go round. And it sort of reminds us of that era because everybody's been chasing tech and semiconductors and a whole bunch of other very exciting industries, absolutely. But the thing that makes the world go round is the basic inputs. And we feel that, you know, the world has not invested enough in those basic inputs. And you're seeing that come back into the fray now with all of these commodity prices going up. The market is telling you that we need more of this stuff and we need the producers to make those long-term investments.
Certainly, we keep hearing dire predictions when it comes to copper.
Dire to the upside.
Shortage, yeah, exactly.
Absolutely. Yeah. We wouldn't be surprised to see copper in the $8 range. I think that's 15,000 a ton. I think it's now 13 and change thousand a ton, and it's going higher because the electrification of the economy and the mass power demand is just going to require many more tons of it.
You do say, though, that some valuations in the TSX, certain sectors are getting a bit rich. What areas of the market?
So it's not that they're necessarily getting rich, but they are a little bit extended, overbought, let's just say. Nothing goes up like a hockey stick. We like to see a little bit of pullback and consolidation before you go higher. Having said that, if you look at the banking index, we're getting a little bit concerned that some of the multiples on the Canadian banks and some of the other financials are maybe getting ahead of themselves. If you look historically speaking, you know, banks have traded in the 10, 13, 14% forward, 14x multiple forward multiples. And, you know, we're sort of in that area. And we think that the market is pricing in this no recession, no slowdown, no credit risk era. And we just think that maybe there's a little bit more risk that needs to be priced in.
What about energy? How are you playing that these days?
So we're very excited about energy. We think that energy is sort of the one commodity that really hasn't gotten much love in the last little bit. We think that we are not decarbonizing, unfortunately, meaning that the world needs oil. And maybe the demand growth is no longer the heady 2-3 million barrels a day. Maybe it's closer to 1 million barrels a day. But the reality is that the energy industry has really not invested the vast amounts of capital needed in order to replenish reserves ready for production. And so we are focused on producers that we think are trading at extremely compelling levels, that can pay out dividends, not take on too much debt, return capital to shareholders, and even grow their production at these low prices. And wow, do they have torque if we're right and prices in, say, the next 12 to 24 months go up a lot from here.
And Cenovus is one stock that meets your expectations.
Absolutely. Cenovus is a very well-run company in our view. They've made some really great acquisitions. The last one that they won was Meg Energy, a very interesting acquisition for them because the land package is sort of contiguous to what they already own. We think they're going to have synergies in that acquisition. The management team is very shareholder focused, but also focused on leading the company in a growth trajectory. And it's sort of an integrated, like Suncor, in that they have some refinery capacity, and that sort of shields them by having the downstream business along with the upstream business.
And another stock, Hewlett Packard Enterprise. What attracts you there?
So it's Hewlett-Packard, not Hewlett-Packard Enterprise.
Oh, I'm sorry.
Yeah.
Okay.
So this is the old personal computer, enterprise computer systems, printing, things of that nature, HPQ, before the split.
So this is HP Incorporated, I think.
Yeah,
HP, sorry. Okay, sorry.
HP Incorporated, yeah. So it's gotten no love. You could see by the stock price, it's down from the 30s last year, now at $20. Well, at $20, what is the market pricing in? Well, you've got a stock that's paying a 5.5 to 5.7% dividend. Mm-hmm. They're generating loads of free cash flow. We believe that there's a rejuvenation cycle happening in compute in general. You're seeing it in the semiconductor space. But what about the average worker who needs more, faster RAM, faster chips, more processing to become more efficient? Well, Hewlett-Packard is one of a handful of names that's sort of that in the business. And what we like about this business is their margins on the computer side are not that big. They're 5 or 6%. But imagine, Andy, if they're able to go from 5.5% to 6.5% by just doing some cost cutting or even importing AI into their business, that drops straight to the bottom line. And when you're looking at a stock that's trading at 7 times free cash flow or thereabouts, that's not asking a lot of the valuation in order to have a margin of safety to the upside, while we believe not much to the downside.
Thank you very much, Mike.
Pleasure to be here.
Mike Vinokur, portfolio manager and senior wealth advisor at Propellus Wealth Partners.